Thank you so much for speaking to us. Well, hopefully the last 2 years, I would say, we have seen a lot of disruption in the entire NBFC sector, vehicle finance, huge amount of NPAs, demonetization coming in, and various other factors. NPAs shot up over 9 or over 10% also. Now that hopefully the worst is behind, what is your broad outlook in terms of growth, especially the fact that we are also entering into a very much election year?
So I've always said this. One is, of course, the profile we work with is a earn and pay segment. And therefore, unless there is an adequate earning, these consumers are not able to discharge their liability. But what is an NPA definitely is not a bad debt in this market. Right. We do meet the customers, we can see the asset, and we do understand their challenges, and therefore you have to partner this customer. And for the reasons that you mentioned, we just come out of poor monsoons 2 years back, infra story was a little slow, demonetization happened. In the same breath, the regulator wanted us to move to 90 days of NPA. Right. So I think the business model got tested through all of this very clearly. As we speak now, I think the sentiments are very positive, good monsoons, and therefore the buoyancy is very high. We do see state-wise infra spend is picking up, and therefore clearly the infra cash flow is picking up. So if you look at our last 5 quarters, every quarter we've registered growth better than the quarter before that, as well as recoveries have shown improvement. I mean, we've corrected our gross NPA at least by 4%. In spite of moving to 90 days. Right. And we do believe that in the same trend, we would see further reduction to NPA happen. So if you therefore ask me to put a summary to this, I would think as much as we suffered across the country, we see correction happening across the country for us. And I would think therefore that both growth as well as asset quality improvement leading therefore to a better profitability is a clear visibility.
So clearly you're seeing that the rural economy cash flows are improving. Typically, just for the benefit of our viewers, since this is also going to be state elections and there is going to be state elections and general elections, can we say that this would also lead to better growth, and also next couple of years we could see far better recoveries? And if you could put a number to that?
At least in the past we've seen, whether it's state or central election, the infra spend does pick up in each state, and that leads to better asset buying, and that leads to also better earnings and therefore better repayment. Right. And therefore we have every reasons to believe that clearly one would see an substantially improved growth, and you would see that improved growth coming from commercial segment, whether it is in the infra machines like excavating machine, or whether it's in the tippers, or it's in the pickup range of vehicles, or tractor with trailers. Okay. Those kind of commercial application product one could see very clearly. And also what we've seen is these assets normally get bought for a shorter cycle of 2 years, 3 years, and not necessarily 5 years, which means even within the 3 years time frame, the whole repayment would come back. So which will also improve the overall profitability. So if I have to therefore put a number to it, I think we at the beginning of the year were comfortable to speak about a 15% growth story. Then as we crossed the first quarter, we saw we already upward of 20% growth. I think we clearly see, and then inventory, of course, the discounts are on, but I think over a period of time you would see even discounts vanish post festival maybe, and then you will see price increases coming in later. Okay. So if all that has to happen, even for the same volume, one could see a higher disbursement, and then add to that the volumes that could happen because of various events that we are talking, I think the growth would be aggressive.
Okay. So the growth would be aggressive, but if I'm looking at your overall return on asset, and that's at around 1.9% right now. But historically, in good times, we have seen ROAs of much higher than even a 3%, 4% odd. So when do you see yourself getting back to at least a 3% ROA, and what would be the key drivers for that?
I think in less than 1 year, from 1% it's moved to 1.9, yes. Right? So it's moved by 1% in 1 year time. Two things contribute to this. One is when you start recovering from the past provided account, that straight away adds to your ROA at least a 50 to 60 basis point. Then when the market conditions are good, your NPA levels are not these elevated, and therefore the asset itself earns for you much more. So clearly in less than 2-3 quarters time, would start seeing that moving towards that 3% number, and clearly that visibility is there.
That is very interesting. And I guess you have already raised good amount of money both via QIP as well as preferential issue just end of last year. Could we say that easily you can grow at least over 20%, or can you give a more aggressive target of 25%, given that you also now have capital on hand and hopefully everything else, be it even in terms of economy and the worst being behind, can we get a little more aggressive in terms of growth?
I think we are preparing ourselves for a higher growth rate, in the sense that we are adding more branches, we are adding more people, we are going more deeper.
Right.
We are also using our large customer base to generate more business for us. And we are today a multi-product company working relationship with every OEMs across the country.
Okay.
What is it waiting for? I would very clearly think you will start seeing the numbers change from the festival season. I mean, the first 6 months in rural is not necessarily the best month to compare. But even in this period, if you have done well, I think we have every reason to believe the next 6 months, that's the last 2 quarters, would be even more aggressive. Okay. But it's also important to note, we don't find too much of competition for us around that place. Okay. Even though we keep talking about someone else entering this market, etc. But with such a high market share and a very penetrated position with a large team operating on the ground with relationship with every OEM, I think competition is not something that we are overly concerned. And therefore, we would continuously restate our growth rate quarter over quarter as we see things pan out.
That's interesting. Speaking about the interest rates as well as your margins, we did see some amount of expansion in spreads even in Q1. Now, given that we are into a higher interest rate scenario, and how do you see both your cost of funds as well as your yields going up? Are you seeing the pricing power coming back for you, and hence despite a tough the interest rate rising environment, is there a further case of margin expansion there?
I think lending rates are never a pressure for us.
Okay.
I mean, it all depends on when and how much do you want to pass on, and to which segment of customer and which product do you want to pass on. So will we increase rates across the country, all product, all segment? The answer is no. But clearly we don't see a margin pressure if the borrowing cost keeps going up. I think we will have the power to pass it on to the consumer. We don't see that a pressure.
Okay. Speaking about the overall, again, the environment, especially in terms of your Ind AS, not too much of impact coming in because of Ind AS. Is all the recognition done with respect to Ind AS?
So we've completely migrated to Ind AS. There is absolutely no gap. And in fact, we migrated about a year back, even though the reporting was not on Ind AS basis, because of us to give it for consolidation to the parent. So there has been an experience of testing it out for a year before we fully migrated. And I don't think we have any head where we have not migrated yet. So it's fully migrated book.
Right. We're seeing some amount of pressure for certain segments, especially on the housing front. You also do have a housing finance subsidiary now. What is the kind of pressure that you are seeing on the housing front, or for that matter, what are the kind of trends also that you're observing here?
So I think it's important that we are not really a large housing finance company in the sense of financing large houses being constructed or bought. We are into house improvement, room addition, room expansion kind of a loan into deep rural. That's our upward of 90% of the book. And there we don't see any pressure in terms of any new pressure in terms of growing the book, etc. But we do have pressure of recovery, which is again related to the local cash flows of the market. And currently we have pressure from Maharashtra, where due to demonetization there was some delay in the consumer side. But we also think that will be the fastest correcting book. As one season unfolds and you start getting the money from the crop, etc., you would start seeing them pay off much, much faster. So as otherwise, we don't see any major pressure. I think we are maintaining a growth rate of upward of 40+% growth in that book. And we've grown to close to about 7,000 crore, and we don't see any pressure there.
Okay. Speaking again in terms of the asset quality, and I hope you can give me a number here, GNPAs at least over 9%. Can I safely assume that we can at least see the NPAs by somewhere around 7% or even below 7% by FY19?
I think that's the target we are also working on.
Okay.
And the trend seems to be moving in that direction clearly.
Right.
And as I very strongly believe that if you look at our NPL accounts, if we have about 1,40,000 consumers in that, more than 50% of them are repaying their monthly installments even now.
Okay.
So there's absolutely no reason for us to not believe that those numbers are achievable, and that's the direction we are in.
Right. Correct me if I'm wrong, your entire book exposure to the state of Kerala would be approximately 3% odd. What is the kind of hit that you see because of the floods in Kerala and probably in other adjoining states as well? And would you see it that there is an opportunity here on account of the state when it starts the entire rebuilding exercise?
So clearly, 3% is the overall Kerala book, but I think the affected area book is about 1 odd %.
Okay.
Is all consumers going to kind of not repay? But I think 6 months, one has to have patience, give them the time. But 6 months down the line, you would start seeing them pay off again, because they need to first re-establish themselves, and that's a support we are willing to provide them as well. And clearly we would see that they would start repaying, because I don't think every one of them would have lost all their assets, at least in terms of what we have financed, the vehicles and things like that. But if some of them have, I think they would be insured, and therefore some would get settled through the insurance company settlement, etc. At this stage, we don't have a complete assessment of how much would get lost. But clearly 1% of the book is there, which would mean about 70 odd crores or so. And we think that at least 50% of them would be safe. The other 50% we will have to assess as we go along, but we will need to give them 6 months time.
You're present in almost every state of the country. Where do you see state-wise more opportunity? Which states do you think are doing better, and hence you would want to improve your penetration in those particular states?
So I think one is a growth rate, but I think the size. So if you look at it by size, North is very large, right? Surely by population size, and therefore for us Bihar, UP is doing well. Clearly it's followed by West, followed by South, and then East. But in terms of growth rate, we do see in East the growth rate is much faster.
Okay.
So we are Northeast present, we are present also in Assam, we see the growth rates are high. But in spite of the growth rate being high, the absolute volumes of those states will always be little low. So in terms of our own overall structure, North is the #1 zone for us, followed by West, followed by South, followed by East.
Again, speaking about the overall performance here, key learnings for you in the last 2 years, and what would be your key challenges that you see despite the fact that we're seeing a better opportunity now?
I think clearly one of the challenge was that we were a very branch structure driven, where a branch manager in the team had to have skill sets to manage all types of assets. I think we have restructured the organization 2 years back, where we have made product based vertical, and therefore we have created specialized skills for each product, but continuing to be ensuring that the lending team also recovers, because it's a very interactive lending, and therefore recovery should be a part of the lending process. So restructuring has been done based on that learning. I think the other learning clearly is to continuously impose training to people and ensure their competence and capability is maintained for all circumstances. I think the third is, in the next level of margin, if we have to protect and grow, we will have to focus on where all can we save on cost, which means investment in technology, using digital very efficiently, using the data very, very sensibly, and forecasting trends out of that would help bring down the cost and help us grow the book.
One big message, be it in terms of growth, be it in terms of margins, asset quality, ROEs, what would you like to give to the investors?
I would think that if you are looking at companies which are focused rural, you must have tremendous patience to live the life the company goes through in difficult times in that market. Because what is an NPA in rural is not a bad debt, and it's a very large opportunity market. And therefore, if a company has very strong fundamentals and stayed there with patience for long, there's every reason that the investor would be always benefited.
Okay, one last question. Would there be any inorganic growth opportunities that you would be eyeing out in the near future?
I think as a financial services company being present in the space of vehicle financing, SME, housing, insurance distribution, mutual fund, I think we would be very open to look at emerging opportunities. But like anyone else would look at, we would look for a good cultural fit. We would look for, is that merger giving us a new geography or a new asset? Is what our approach would be. But clearly we don't see pressure of growth on the asset side. But if this growth can be accelerated through a merger process, we would be open to it.
Are you looking out for anything?
To be honest, not at this stage. We are very, very focused on organic growth, and we are setting up everything around that.
Well, thank you so much, Mr. Iyer, for speaking to ET Now.
Thank you.
Pleasure speaking to you, and wish you all the best.
Thank you so much. Same to you.